Michael, in terms of what the Fed did today and what Jay Powell said today about inflation specifically, broadly on track, he said, but emphasized how it's taken a bit longer. I'm just curious whether you think that the chances of a rate hike next year, what are they, Michael?
I think it's unlikely we'll get a rate hike next year, but I do think it's likely, and this is, I think, the first time we're starting to hear about it, that people are going to increasingly talk about it. First we have to price out any further rate cuts before we start to talk about a hike. But on the way there, and this started kind of in September when we had a lot more rate cuts priced in compared to what we have now, and now we only have less than 2 rate cuts priced in. We're starting to think about that, where this could go. Again, markets tend to extrapolate. What could change this? Real simple. If you continue to see the unemployment rate slowly go higher as it's been doing for a year, that could put a lid on yields and I think would be bullish for equities.
So this is really interesting, Michael, because the narrative for so long was, as long as the economy is sort of plugging along here, even in the interest rate increasing regime, when it was that stocks could do okay, right? And we heard Jay Powell, he talked about a lot of uncertainty, but one of the things he did not seem to be uncertain about was the solidity of the U.S. economy. So I guess I'm trying to think, but you're saying if things get a little bit worse and rates come down, that could be good for stocks. I guess I'm just trying to sort of process all of this.
Yeah, it goes back to kind of thinking about what the primary issue is for equities. So almost a little more than a year ago, we held on to a bearish call too long with many others in the recession camp, but then changed our view in October of 2023 because it was clearly evident that higher interest rates were the problem for equities when we saw that last, I think it was a 12% correction in stocks. So our message back then was that anything that brings down interest rates and gets the Fed to pivot will be bullish for equities, including higher unemployment. So we're kind of still there in terms of that view. The relationship between interest rates and equities has ebbed and flowed in recent months, but clearly we're back to a pretty negative correlation. So again, the problem of, when you listen to investors, people are not worried about the economy falling off a cliff, but they are worried about higher inflation. And I think 2022's experience created a paradigm shift in investor sentiment, where if I think about most of my career from early 2000s through 2021, pretty much every market sell-off was a function of a growth scare. And think about the recessions or periods during ZIRP. Whereas in the last couple of years, really, markets have only gone down because of rising interest rate or inflation fears. And I think that's the new normal, that going forward, market corrections are going to come from higher rates, not slower growth or higher unemployment. And when you look back far enough throughout history, that's actually the more common reason equities go down compared to the last 20 years.